Good afternoon, everybody. I'm John Schonberg. I'm the Chief Investment Officer of Stonebridge Capital Advisors. I want to welcome everybody to our economic forum today. It's good to have people online and here in the room. It's the first time we've had a live audience in quite some time. We're going to discuss a lot today. There's been a lot happening in the U.S. economy as of late, with inflation picking up steam and interest rates starting to rise. And there's really nobody better to answer that than our economist, Dr. Dan Laufenberg. I've known Dan for 26 years, and he's been one of the best economists and had so many right calls on the U.S. economy. I can't say enough good things about him. Dan's going to speak, and then I'm going to be coming up to talk about how we're incorporating that economic outlook into our equity outlook and how we're managing portfolios, both on the equity side and the fixed income side. And then we're going to have a chance for the audience to ask questions, including anybody online that would like to chat in the forum and ask a question there as well. So with no further ado, I'll introduce Dr. Dan Laufenberg.
The economy, I think, is going to do reasonably well, although certainly not as well as it did last year in terms of growth. Unemployment rate is probably going to test a new low, or at least test the record low of the early 1950s before the year is over. This is different from what the forecast said a month ago. If you recall, last year at this time, I said I thought the unemployment rate was going to get to 5% on average by the end of 2021, down from 6.8% on average in the fourth quarter of 2020. Well, it got down lower than that. It got down to 4.6%, I think, by the end of the year, and is now at 3.6%, which is not too far from my 3.5% number that I had in the forecast last month. So we're already there. I don't think we're finished. I think the economy is going to grow fast enough to get the unemployment rate to go down even further. So I'm looking for the unemployment rate to test that previous record low. Not quite the 2.5% that we got in the 1950s, but certainly something closer to 3%, I think, by the end of the year, which would be pretty amazing. And we'll discuss this in more detail in a moment. Inflation on the year-over-year basis will likely peak soon, regardless of what the Fed does. The Fed has already raised rates 25 basis points. We know that. They're expected to do far more. But I would think that the Consumer Price Index, the inflation number as measured by Consumer Price Index and by the Personal Consumption Expenditure Index, both measures I think are going to peak very soon. Either they peaked in February or they're going to peak in March, and I think you're going to see a bit of a gradual slowdown. The problem is that the level of the inflation rate is still going to be elevated well above the Fed's target of 2%. Which means the Fed will still have to pay attention. The Fed is probably still going to have to raise rates over the course of this year and maybe into next year. We have in our forecast the Fed basically doing 25 basis points every meeting between, starting last month, March, last month of March through the end of the year, every meeting, for a total of 175 basis points of tightening at the Fed funds rate. Given comments that we heard from Fed officials in the last 24 hours, they're now saying that maybe a 50-point move at one of those meetings may be necessary. That certainly isn't impossible, but given that they're going to be, I would think, somewhat gradual in their approach, that might be maybe a little bit of overkill for them at this point. Especially if they're going to truly start to reduce their balance sheet, as they also announced today at 2 o'clock from our time. From the minutes of their last meeting, they said that they were going to reduce their balance sheet by $95 billion a month. I think it was $60 billion in treasuries and $35 billion in mortgage-backed securities that they're going to reduce. So if that's going to, and basically it's going to be runoff. They're not going to repurchase anything that matures. So if something matures, they're not going to replace it. They're just going to let it run off. And so that's something that they're going to be doing soon. They're going to gradually work into it to get to the 95. I think they said they're going to give them a 4-month window to really get to the $95 billion. But the point is, that's going to have an impact on longer-term rates. So longer-term rates, I think, are probably going to be moving up as they did today. It'll be interesting to see just how high they will go with the Fed when the Fed actually starts reducing their portfolio. They're only talking about it now. They haven't done it yet. They only raised the short Fed funds rate 25 basis points. They're talking about doing more. They haven't done it. So we'll have to wait and see. The economy, it's really interesting. The economy gives all indications that we're late in the business cycle. It's amazing. We're late. We're in the late stage of a business cycle. You know, you have the Fed raising rates. You have talks about the yield curve inverting. You have inflation at 40-year highs. You have all these factors. The unemployment rate very low, 3.6%. We have all these factors that suggest that the U.S. economy is in the late stage of an expansion. It was only 2 years ago that we were in the late stage of the last expansion. This expansion has, I think, broken all records in terms of how fast it unfolded. It started with the recession. We had a recession in 2020. It lasted 2 months. Remember that old rule of thumb where a recession used to last at least 2 consecutive quarters of declining real GDP? 2 months is now the new definition, right? So there's a precedent. So it was unprecedented in the sense that you had a very quick recession, you had a very severe recession, you had a very robust rebound from that recession. And so here we are, we're at a point in the business cycle now where we look like we're at late stage. Part of the reason that we have inflation right now at the pace that we do, I think in part is because of how quickly all that unfolded. I mean, you had a surge in demand, you had supply that was being constrained for various reasons. It was difficult to satisfy that demand, and therefore you had price increases transpire. You had excesses that led to pricing pressure that led to inflation. So that's part of the story. We're in the late stage. One of the things that was sort of interesting is that that consumer spending, when you talk about the late stage, it's an unusual recovery in the sense that a lot of the recovery that we had in 2021 was in the goods sector. Consumers were spending money on goods far more than they were spending money on services. And when you start talking about things like supply disruptions, you know, generally you don't talk about supply disruptions when you're talking about services. You usually talk about supply disruptions when you're talking about goods. So if you had a situation during the pandemic where we were basically providing individuals with money, you know, our relief checks, we had providing them with money to help soften the pain of the effort to try to control the spread of the pandemic. But at the same time, you were telling them not to go anywhere. So you're giving them money to spend, but telling them not to go anywhere. So where are they going to spend that money? They're going to spend it on goods. Because we make it a lot easier to spend on goods. Now we have the internet, we can order it, it can be delivered to our house. We don't have to go anywhere. So goods certainly represent sort of the unique or almost the single method or avenue in which the consumers could spend that money that they had. So there's no wonder that you had a surge in the demand for goods. It's no wonder that you had some supply disruptions because we didn't, even if the capacity came back, I'm not sure we had enough capacity to satisfy all the demand that we had. And not only that, it seems to me that you had price increases that resulted in this that led to that story. And you can go back and look at the numbers. It's really amazing. Goods spending by consumers is about a third of the consumer spending total. Services account for 2/3. Yet in the first half of last year, consumer spending was very robust, and goods spending accounted for 60% of the increase in consumer spending. Unlike the second half of last year, where consumer spending was very anemic, almost sluggish by only growing 1.6%, but none of that came from the goods side. It all came from services. So what you had basically is you had an economy in 2021 where there was very strong final sales demand in the first half, sluggish final sales demand in the second half. The growth that we got in the second half basically came from inventory accumulation as businesses were building inventories back up after that surge and expecting that there'll be a demand there to use up those inventories. So when you look at the first half of this year, where's the growth going to come from? Well, the growth is probably going to come from final sales. That's the only place it has to come from because you're not going to add any more inventories. Inventories are already at levels that probably are going to be sustained. They're not at record highs. They're not totally out of line, but certainly they're not at a level that suggests that there's a huge buildup in inventories necessary to provide further growth. And so you're probably going to need final sales growth in the first quarter and probably again in the second quarter to get to that kind of growth. One of the reasons why we think the economy grows at 2.7%, not 5.5%, because you're not going to get that contribution from the inventory build that you did in 2021. So late stage. One of the things we talk about when we talk about late stage is an inverted yield curve. Don't you love that? When I used to write about inverted yield curves when I worked at my former job, my administrative assistant used to roll her eyes and go, "What the hell are you talking about?" Inverted yield curve is basically a situation where the short-term treasury yield is higher than the long-term treasury yield. It's inverted. The normal shape of that yield curve is that because it's longer term, it should have a higher yield. Short term should have a lower yield. Same risk characteristics. It's both government credits on both sides of the spectrum. So you should have, if you're going to hold it over a longer period of time, you should get a higher interest rate. That's a normal curve. When the short rate gets above the long rate, that's an inverted curve. A lot of people are making noise about how the 2-year treasury yield was above the 10-year treasury yield. And I heard some people say that whenever that happens, a recession is just around the corner. That's a good signal of a forthcoming recession. Well, two things. One, I don't think the 2 to 10 is the right segment of the yield curve that you should be looking at. I think it should be at least 1 to 10, if not 3 months to 10, that you should be looking at. That gives you, because that always happens. For example, before the last recession, 2 to 10 didn't invert. 1 to 10 did. So just to let you know that maybe a shorter yield a yield on a shorter obligation at the short end would be better than the 2. So 1 to 10, has that inverted? No, it hasn't. By the way, the 2 isn't inverted anymore either. 2 to 10 is now positive again. Not very much, but positive. So when you talk about an inverted yield curve, I think you need to focus on at least 1 to 10, not 2 to 10. And you should think about an inversion that lasts on average over an entire month. It's not just that it inverts in a day. It has to be inverted for a while before it's very meaningful. And so what we may end up with is a situation where even the 2 to 10s aren't going to invert for the whole month. They inverted for maybe a few days, but not for the whole month, on average for the whole month. And with the 10-year treasury yield bouncing up like it has, it makes it even less likely that that's going to invert again before long. The other thing is that when they say that you have an inverted yield curve, a recession is just around the corner. It depends. The lag time between an inverted curve and the start of a recession, anywhere from 5 months to 4 years. right? And so I don't think it's going to be 4 years, but it's going to be more than 5 months. So once it inverts, and it's not there yet, once it inverts, then I'll start counting the clock. I'll be looking at I'll set my timer, and we'll see how long it takes. But my guess is probably going to be about a year beyond that point before you have the recession. So that gets to my next sort of point. Are we going to have a recession? Yes, we will have a recession. Ask me when, I don't know. Ask me how severe it will be. I don't know that either. I'll have to wait until we get closer to tell you either one of those things. But it's not yet. Business cycles are part of our DNA. We do have business cycles. Whenever you have markets clearing resources, you're going to have business cycles. You're going to have recessions. You're going to have expansions. The key is to try to manage those business cycles so that the recessions occur either less often or that they're less severe when they do occur. And that's the best you can hope for. You can't avoid them. You can just try to manage them to some extent. Which reminds me, the Fed never plans to engineer a recession. That's not on their play sheet. Their playbook does not include a recession. I was at the Fed on their research staff for 14 years. I was part of the group that put together the econometric model forecast for the U.S. economy. That's what we did. We provided the econometric forecast. Now, you have to remember the Fed's forecast back then wasn't just the econometric forecast. They had a committee that would meet, and you had our forecast from the nerds that ran the model, and then you had this other judgmental forecast from a group of people that were really smart and intuitive, right? So these two groups of people would meet, and they would come up with the board's forecast. So the board's forecast never really reflected the model forecast, although over the years the model forecast became more and more important to that process. But we never had a recession in any of those forecasts for 14 years. You know why? Because we thought the Fed could manage monetary policy in such a way that we could avoid a recession. Isn't that what the Fed is telling us now? Soft landing. Avoid a recession. We're just going to slow things down. We're going to try to take some of the excesses out of the economy. We're going to try to bring inflation back in line with our goals. But we don't want to really disrupt the economy very much. We don't want a recession, certainly. We may not even want to raise the unemployment very much. Good luck with that, right? By the way, during my 14-year tenure at the Fed, we had 3 recessions, and 2 of them were pretty nasty. But that's beside the point. I had nothing to do with it. When we talk about the economy, I think there's a couple of things we need to talk about. One is the unemployment rate. I think we're going to test 3%, and I think that's a pretty far out forecast right now. I don't think anybody else is suggesting that could happen. I think a lot of people are expecting the participation rate to start to move up. In other words, people that haven't been participating in the labor market are going to come back in, and so that's going to make it more difficult for the unemployment rate to go down because you're going to have more and more people looking for jobs. Those jobs have to be filled. So having more jobs isn't going to be enough to get the unemployment rate to come down as much as it would have otherwise. I think there will be some increase in the participation rate. In fact, I would say that the silver lining to higher inflation is that you probably do have more people coming back into the labor force because they're looking for income to supplement their household income because they can't afford to do anything with the prices as high as they are. So there may be some of that. But at the same time, you have 11 million job openings right now that need to be filled. There's a lot of jobs out there that are going empty, that somebody's going to have to fill these jobs. And I think that those kinds of things, plus with the economy growing at even 2.7%, which is above our potential, suggests that the unemployment rate will go down further. By the way, I don't have it going from 3.6 or what was it at the end of the last year, 4.2 or whatever it was, 4.6 to 2.5. But I do have it going from that 4.2, I think it was, 4.2 to something close to 3 by the end of the year. So that's sort of how I came to that conclusion. It wasn't something that I just picked out of the sky and said, hey, this is a nice round number. Let's use that one. So there is some logic behind it. Inflation, I don't think I need to say anything more about inflation. Inflation has been really on a non-event for, 30 years? We really haven't worried about inflation. In fact, it wasn't inflation, it was deflation or disinflation. Those are the words that we use to describe price changes. We didn't use inflation. And whenever we had inflation, we always said, well, it's transitory. Well, if it's transitory, it's really not inflation. If it's transitory, it's probably a sharp shift in relative prices. It's just a relative price change that needs to adjust. Because what happens is that if the price of one thing goes up and there's a substitute for that, you're going to go out of that one and you're going to buy this one. And so what happens is that price goes down, this one goes up a little bit, and it sort of balances out, so you don't have any more inflation. It self-corrects, it's gone. So when people talk about supply disruptions as the source of inflation, I sort of ask myself, okay, there are several ways to disrupt supply. Is it because of the pandemic? Is it because you don't have people going to work, or you can't produce what you need to satisfy the demand that you have? Okay, so how do you fix that particular problem? If that's the problem, how do you fix it? Well, you don't raise rates, right? You try to get everybody healthy. You try to get the pandemic out of the system, that it's no longer an issue. Maybe it becomes an endemic, not a pandemic. That's your goal. And so maybe you encourage people to do what they have to do. If it's a vaccine or if it's whatever it is, you just try to do it to get it out of the system so that it's no worse than the flu. That's one issue. If the supply disruptions are due to the war in Ukraine, higher interest rates aren't going to help you there, right? That's something else. There's another issue that has to be resolved. It's not higher interest rates. But if it's not disruptions, if it's the fact that you just had such a strong demand for goods in face of sort of a limited capacity to produce these goods, because we've never had this kind of demand for goods before, then it's inflation that can be, in part, corrected by a tighter Fed policy, because one could argue that the very accommodative monetary policy was part of the problem to begin with. We're just going to try to take some of that off the table. We're going to stop pouring alcohol in the punch, right? We're going to stop spiking the punch bowl. It's over. It's not a party. It's an economy. So that's what we're going to try to do. So inflation, I think, is probably going to come down. What does it come down to? I think the really low inflation scenario that we enjoyed over the last 30 years, I think it's over. I think if nothing else, the Cold War has returned, right? The Cold War, which means that now we're going to be spending more money on defense than we did before. We're not, it's going to be somewhat inflationary in that sense. Not just the Cold War, but that's one of the issues. Demographics. We're old. I'm old. I should speak for myself. I'm very old. And so it's going to be difficult to get people to continue to work in the labor force. Bob pays me, but I'm not sure he would consider me doing any work. But anyhow, it's I'm still in the labor force because I get paid. Thank you, Bob. We talked about, the Cold War, geopolitical uncertainty. Pandemics. The pandemic still is haunting the economy. It's not done yet. It's not gone, which is too bad. We would have hoped that it would be out of here by now, but it's not. And so that's one issue. I don't know exactly, I wouldn't call it nationalism, but maybe deglobalization. Because globalization was a big part of the disinflation that we enjoyed over the last 30 years. Remember all the jobs that went to Mexico, and all the jobs that went to Japan, or all the production went to Japan, then all the jobs that went to China. I mean, we had a lot of other countries that were really producing the goods, consumer goods in particular, that we bought. I think that's probably not necessarily ended, but it's not going to provide the added growth to consumer products that it did before. We're probably not going to be buying a great deal more from China. We're not going to be buying a great deal from Japan. We're not going to be buying a great deal necessarily even from Mexico. Although Mexico might be the more logical of the three. And then inflation expectations. We got to the point over this last 3 decades where inflation expectations were extremely low. If you ask somebody, well, how much are prices going to go up this year? They'd say, maybe 2%, probably less. You ask economists, they'd say it's probably 1%, right? But the general public was probably around 2%. Now, inflation expectations, according to the Michigan survey, is around 4.9. Inflation expectations are up. Why is that important? If you expect prices to go up, then you're not so disappointed when they do. You may be disappointed, but you're more tolerant of those prices going up if you expected them to go up. That's what you expected. Oh yeah, I knew it was going to happen, right? So you expected it. So it makes it easier for businesses to pass on higher prices if they're facing higher costs. So those expectations start. I get a kick out of commentators and maybe even central bankers that now talk about inflation expectations being well anchored. I'm sorry, but their anchor moved, right? It's not 2% anymore. It's probably closer to 3.5, 4, maybe even 5. But I would say that over time, going forward, it's probably going to be closer to 3.5 than the 2 or less that we had before. People are going to be more tolerant of price increases, and we're going to see those price increases continue to go through. Bottom line, the economy still looks like it has some life. I don't think it's dead yet. The Fed's probably not going to want to kill the economy, although unfortunately that may be how it turns out. It's too early for me to say with any certainty. But given the track record, it looks like the Fed is probably going to end up doing more than it probably needs to do to get the job done. You need a recession. I'm sorry. With inflation running as high as it is, you're probably going to need a recession to get that inflation out of the system. What you don't want to happen, here's what you don't want to happen. You don't want the Fed to sit there twiddling their thumbs, not doing anything, because then you might get an extended period of stagflation. That's when inflation keeps going up, but the economy doesn't grow hardly at all. There's hardly any growth in that scenario, but inflation keeps going up. I want to remind you of what happened in 1970 to 1980. Do you remember those years, John? Barely. Yeah, I know you're a young man. The stock market had its cyclical peak in December of 1972, S&P 500. Had its cyclical peak in December of 1972. It didn't exceed that peak again until July of 1980. You basically had 8 years where the stock market went down or sideways. I'm just telling you, stagflation is not pretty, especially for our business. So I don't think we're there. I think the Fed is doing the job. I don't think you're going to need another Paul Volcker to step in and convince Congress that you should have Fed funds rate at 25%. One of my great stories. I'm sorry, I probably told you this story, but it's one of my great stories because I happened to be there when that was going on. And Paul Volcker was a very, very savvy political person. He had been around the block. He had been president of the New York Fed for many years. He had been at the Secretary of Treasury, in the Treasury Department for many, many years as one of the undersecretaries. So he had a lot of experience, a lot of political experience, and so he knew what he had to do. So at that time, the Fed was influencing short-term interest rate, the Fed funds rate. That was their policy tool. That's the only thing they had, was the Fed funds rate. There was no way that Paul Volcker could go to Capitol Hill and tell Congress that we needed to raise the Fed funds rate to 25%. He was getting death threats as it was. I mean, I remember when one guy with a bag, with a pistol in the bag and a shotgun taped to his leg, made it past the first line of security, up the steps, and was tackled by the guard just outside of Volcker's office. He was going to hold the Federal Reserve Board hostage until interest rates went down. Good luck with that one. So anyhow, I don't think we're going to need another Paul Volcker. I don't think we're going to get there. I think what the Fed needs to do is the Fed needs to act. It needs to do what it has to do to get inflation in line. It can't wait. If you're going to manage this thing, manage it effectively. Don't get caught like we did in the 1970s. So that's my bottom line. That's my message. I'm finished. Now the good part of the program begins. Here's John.
Thanks, Dan.
Or Johnny.
Yeah, thanks. Thank you, Dan. So, follow that. Recession is coming, but we don't know when, right? So, there's a lot to unpack there. I would say that what I hear Dan say is the economy is still growing. But much slower than it has over the last couple of years, which we would expect, right? The Fed really stimulated the economy during the pandemic. It drove some crazy things in the market. We all saw that. I can touch a little bit on a couple of those items. But things have slowed down from there. And the pandemic, and it's caused inflation, right? That whether it's supply disruptions, whether it's the war, whether it's too much demand and not enough supply, we have inflation now, right? And we went from 3 to 4 to 5 to 7. And everybody said early, oh, it's transitory, it's transitory. Well, it's not transitory, right? We kept saying in our group, what's the definition of transitory? Is it 1 month, 3 months? Is it a year? It's definitely not transitory. It is here. We're dealing with it. And the Fed is raising rates. And the yield curve is kind of inverting, but not inverting. I mean, there's a lot going on. I would say at Stonebridge, on our investment side, we feel pretty well prepared for everything that's happening right now. Surprisingly, we have an equity side, we have a fixed income side. On the fixed income portfolios, we have been short in our maturities for many, many years, expecting interest rates to bottom and start to rise. If anything, we were early in that call, and we had our portfolios a little too short for a couple of years early. But guess what? Now is the time to be short. As interest rates rise, bond prices decline. The average duration in our portfolios is literally 3-4 years. We expected rates to rise eventually, and it's happening. And I look at our numbers in the first quarter. The bond market was down 4.5%, and most of our accounts on the fixed income side were down 2%, right? So much less than that. And given Dan's outlook, interest rates are going to continue to rise for the foreseeable future, and our portfolios should consider to do very well on the fixed income side. So we feel really good about that positioning. On the equity side, during the pandemic, the markets really, really went crazy, right? The Fed threw trillions of dollars at the consumer. And guess what? People stayed at home and they started buying stocks. And I said to people, it reminded me of the day traders in 99 and 2000, where people were quitting their jobs to stay home and trade stocks. That ended badly for a lot of them, and they all went back to work eventually. But the same thing was happening now, right? People had this extra capital. They had nothing to do. They got interested in the stock market. Reddit became a thing. David Portnoy became a thing. I mean, people were excited about investing again. And that's not all bad. A lot of that was good because you got a younger generation interested in the market. But it created a situation where people were just buying things because they were going up. It wasn't really investing. And I would say, if anything, at Stonebridge, we're investors. We buy stocks that we think are going to perform well, given our outlook for the next 3 to 5 years. That's what we have always done. It's what we did during that. We missed out on some really fun times. We didn't buy GameStop or AMC or any of those crazy things. And that's paying off, right? We didn't get sucked into companies that we thought were kind of zombie companies, that the only reason they were in business is because they got funding, and they got a lot of funding, and they could keep getting funding. They didn't really make any money, and we weren't sure if they were ever going to make money, but people wanted to buy the stock because it was going up. That's definitely ended. We've seen many of those stocks come down 50%, and they're probably going to come down another 50% as interest rates go up, and people have to focus on real companies that earn real money. On the inflation front, we've been preparing accounts for that as well. In our growth and income and our dividend income strategies, we have purchased names on our clients' behalf that will benefit from an inflationary environment. We're buying companies that can pass on the price increases in their products and to the consumer that will actually benefit their earnings. So we've been making a lot of subtle moves over the last 2 years. We agree with Dan. We don't think the recession is between now and the end of this year, but we are leery of a recession. And we will continue to, manage the portfolios in accordance with that and to become more defensive at the right time. One of the interesting things going on right now is there is no real good alternative for investors, right? You look at the fixed income market, and do you want to go buy a bond right now in the face of rising interest rates where you're still only getting paid 2.5% or 3%? No, you don't, because that bond is going to decline in value if rates continue to go up. Do you want to go buy new real estate right now? Real estate's kind of like the market at all-time highs. Do you want to go out and purchase a rental property at this time? No, you probably don't. So I come back to what is still a pretty decent investment, right? It's the U.S. stock market. And there are many, many companies that are continuing to do well even in this environment. And I think that's the important thing. We manage a portfolio of stocks in all of our strategies. We own technology stocks. We own energy stocks. We own basic materials stocks. We own a portfolio of securities. And not all those securities are working together at the same time, right? Some are going up, some are going down. And that's really the benefits of diversification and having a portfolio and a strategy in that portfolio that takes into account an economic outlook and picking the best companies given that outlook. And that's really what we're trying to do for our clients. And we do it every single day, every single week, and we work hard to find good ideas and to find good investments for our clients. So, Ryan said something the other day. What do we expect? We expect the market to be much more volatile over the next 2 years. The straight up that we had over the past couple of years, we think that's over. We think it's going to be extremely volatile, up and down. And Ryan said it best. We want to take advantage of that volatility. We don't want to be taken advantage of by that volatility. And that's the way we're thinking about things now. We're looking for opportunities of stocks that have declined and stocks that have overshot. I mean, if there's anything, we've pulled a ton of demand into some stocks in the last 2 years, and their earnings look really good right now, and they're probably going to slow down, particularly on the good side and in retail. But there's other areas of the economy that are just opening, like airlines and hotels that people haven't done, and restaurants, right, that are going to start seeing an increase in demand. And that's what we try to do every day, is we try to, sell some of the winners that have been great for us and buy some of the stocks that we think have come down enough and we now think are attractive. So that's kind of where we are. The last few years have been, to me, more frustrating, and to us as investors, more frustrating than where we sit today, right? Because for the last 2 years, everybody was smart. Everybody could pick a stock. Everything was going up. I mean, not everything, but a lot of things were going up, and a lot of stocks that didn't make sense were going up. And clients would ask, why don't we own GameStop? Why don't we buy Bitcoin in our accounts? I mean, all these highly speculative things that you feel smart when you own them for a while, and then they start to go down. And today, we're in a different period where not everything is going up. And I think it helps us internally, because clients are going to need us again. Right? Clients are going to need their advisor. They're going to need a professional, because not everything is just going up and it's free money and it's a big party. So I think it's a great opportunity, for advisors to meet with clients and to really ground them and say, okay, we've had a really good time. What are your risk tolerances? What should we be buying? Should we reduce equities? Well, if you do, you're not going to make very much in returns, because there's not much alternatives in yield. So I think the next couple of years, I feel good about it. I feel great about the way we have our portfolios positioned for our clients. And I think it's going to be a much better time to gain clients for advisors and for us, because it's not going to be as easy as it was over the last couple of years, where everybody seemed to look smart. So that's kind of where we are. Like I said, I feel great about it. It's going to be a rocky road. Make no mistake about it. It's not going to be as easy as it was, but that's why we're here. That's why we're managing money every day on our clients' behalf, is to try to do the right things at the right times. So with that, we'll bring Dan back up, and if we have questions from the audience, or Pat has questions from the... Whoa, Pat, easy on the mic.
Hello, John. How are you?
Very good.
Good.
Come on up here, Dan.
We have a couple of questions from our virtual audience, so I'll ask them, and you guys can just pass the mic and answer them. Isn't the biggest elephant in the room out-of-control spending of the U.S. government? Dan.
Nope.
The biggest elephant in the room, the U.S. government is spending money. One of the things we have to be aware of is not to get too carried away. I thought they could have spent their money a lot more wisely than they did. I said that a long time ago. I've been saying that all along. I think they could have been smarter about how they allocated the money. I've never been a big fan of helicopter money, where you just dump money on the economy. It's just, it's a great way to get inflation in the economy, and that's what it did. That's what it did. So, no, I'm not a big fan of that. On the other hand, we got an incredible recovery from the recession that was dealt us by the pandemic, or the efforts to control the pandemic. And it was pretty impressive. What I'm concerned about more than anything is that fiscal policymakers will use that as their playbook for future economic downturns. That every time the economy looks like it's starting to roll over, every time the unemployment rate starts to move up a little bit, the federal government's going to step in and provide us with all kinds of relief money to offset the pain. You don't do that. The pain is part of the process. The pain is what you need. You need some creative destruction to get us to the next stage. You don't control markets you can't control the economy to the point that you don't allow the economy to do the markets to do their thing. I always have said, and maybe not in this group, but I've said, a controlled economy is stable but stagnant. a free market economy is volatile, but robust. So what you have to do is make sure you have some combination of those, and what you get when you get the government dumping money on the economy like they did, that's too much control. I'm sorry, that's just too much. And you have to worry about that. Now, the other thing that I didn't like about it was that it was going to put a huge burden on the future generations to service that debt, not to pay it off. We're never going to pay off the government debt. No one's fooling anybody here. You're not going to pay down the federal debt. The federal debt's there forever. In fact, I would argue that, I'm going to change subject a little bit here, I'm sorry. The Fed may find that it's not going to be able to reduce its portfolio as much as they think. Because you have to have somebody willing to buy those things. Interesting.
We do have some other questions as well. Why would airlines, hotels, and restaurants be attracted if we are headed into a recession sometime soon here?
So again, that's a matter of timing, but when you look at the airline and the hotel business, nobody was flying, right? Nobody was going to hotels. And some of that has come back, but what part of it has come back? It's been the consumer that has come back first, right? They're finally going on vacations again. They're flying to see their parents that they haven't seen in 2 years. They're going to weddings. They're doing these things. What hasn't come back yet and is just starting is business travel. And the business travel aspect in the travel world is the profitable piece, not the consumer side, right? The consumer was willing to take the extra 3 stops to get to their destination to get the low price. The business traveler is willing to pay full price to go to their destination, and they do it in 2 days, right? They don't stay over a Saturday. They don't do that. It's much more profitable. They also are willing to spend more on hotels and stay at nicer hotels because they're on their expense account. So we've seen travel open to the consumer, but it's really just starting to open. I mean, I went to my first conference this year, right? We are starting to travel to see clients again for the first time in 2 years. So while there may be a recession looming, the business travel is going to start to pick up. And in our opinion, that is the most profitable area. And by the way, those companies aren't like rolling in the profits yet. We think that's on the forefront. So it's a little bit of timing, but even in a mild recession, which I don't think we're calling for the next recession to be as bad as the last one, right? We're calling for a slowdown. Well, the last one was only 2 months, but it was deep. It was deep, though, right? So that's where we are on travel and travel related. We used to call it the reopening trade. We made some investments for that, and we're finally starting to see it, but we're still early on that.
The interest rate environment is crazy. Rates much lower than the rate of inflation. Is this a problem?
So it is. The real interest rates are exceptionally low, given where inflation is today. And one of two things need to happen, right? Either inflation needs to come down, or rates need to rise to be above the inflation rate. I actually think it's going to be a combination of both. I think inflation is going to slow, and interest rates are going to rise, and we're going to get to a position where we have real interest rates back to the long-term norm. It's just going to take time.
And I would argue that the Fed is trying to achieve a more normal level of rates, more normal policy, and that would imply that rates are going to be higher than they were in the past few years.
That actually might be good for retirees too, right? Yeah. We're not there yet, but if we got to a place where there were 5 or 6% interest rates in a treasury bond, that's pretty attractive for a lot of people.
3 doesn't sound too bad.
But do you think it'll stop at 3, Dan? Yeah.
I don't think so. At this moment, I don't think so. At this moment, I don't think it's going to stop at 3. I think there will be a higher long-term yield. If you want to know where it's going to stop, I would say right now that 3 is as high as I'm willing to go, but I'm willing to revise my forecast at any minute. And I hold that rate.
Well, if your long-term inflation outlook is more like 3 to 4, right? Interest rates have to be 4 to 5, right?
Well, it's going to be the inflation outlook, I think, is going to stay above the Fed's target. So the Fed's target is 2. So the Fed's going to try to get it back to 2. The problem is it's going to take them a long time to get there. So it's not like 2% inflation isn't impossible. It just means it's going to take a long time to get to that rate, which means that interest rates are going to start to reflect the inflation rate more than they have at the moment, or are doing so at the moment.
Right. Is this working? So the one thing that I have talked to Dan about, it's the resiliency of the U.S. consumer, and we didn't really touch on that yet. Inflation is a problem for the consumer if they don't have rising wages that help offset some of that, right? And right now, Dan and I talked yesterday about the consumer in the U.S. economy is still in pretty good shape, right? Their balance sheet is okay. They've seen a little increase in their wages. Retirees, because their income is based off the CPI, are going to see pretty significant increases, right, in their income, which is going to help kind of offset some of these inflationary pressures. So I think as long as that inflation rate starts to moderate, we're going to make it through this, but it is a problem, and we're all seeing higher prices. We've actually seen higher prices for a long time. We just haven't really felt them like we are now.
Yeah, I'm glad you brought up the consumer, John, because there was something I was supposed to talk about. And so I'm going to talk about it right now. The consumer does look like they're in pretty good shape, both in terms of income, because we are still getting jobs. The jobs are really important. Now, their wages aren't going up as fast as inflation did, but that will continue. Their wages will continue to go up, whereas inflation may slow. So that will be sort of a catch-up for them. But I think the more important thing is that they have jobs. There's lots of jobs out there to have if they need a job. They're going to get some income. But I think more importantly for consumers in face of higher inflation is, do they have the ability to borrow? Do they have the ability to dissave to sort of maintain their spending, at least for a while? And I think they do. The household balance sheet still looks in reasonably good shape. The saving rate is 6.3%. That's still high enough, I think, to allow consumers some room to maneuver in terms of dissaving. And dissaving occurs basically if you're operating on a budget that's a little strained by higher prices. What you end up doing is you end up borrowing money to help get you over the hump, hoping that it's not going to last forever. If it lasts forever, then you're in trouble. But you need or you get a raise. You get a raise to pay it off. One of the two.
All right. What do you see as the ramifications of the collapse of the petrodollar?
The collapse of the petrodollar. Does that refer to the fact that the dollar is being used less as payment for petrol? Is that what they're referring to? A lot of people have talked about the reserve currency, the dollar's role as a reserve currency being lost. I would argue that it's a long ways from happening. I think the dollar is still going to be the reserve currency. It's going to be one of many, but it's still going to be the dominant one. And until you come up with an economy that has a military as strong as ours, an economy as strong as ours, you have laws that allow for property rights. You have laws that allow for protection of ownership. You are going to be, you're not going to replace the U.S. The U.S. currency is the reserve currency of the world because people are pretty confident that if they own the dollar, they can get something for it. Somebody is willing to accept it. If nobody else, the U.S. government. So I don't think it loses that role. It's certainly it's something that it doesn't. There's no guarantee that it's going to be that way forever. There may be another currency sometime down the line that will replace the dollar as the premier reserve currency. I don't see what that would be at the moment. It's certainly not the yuan. I don't think it's the euro. It's certainly not the ruble. So what is it that's going to provide that kind of reserve status? Is it going to be a cryptocurrency of some sort? No. No. It's not going to be cryptocurrency because a reserve currency, one of the things you need from a reserve currency is transparency. You need to know who owns it. And if you got cryptocurrency, you don't necessarily know who owns it.
It's all in the blockchain, Dan.
Gotta watch those currencies.
All right, we have two more questions here. John, could you provide your thoughts on the real estate market?
Yes, I can. So the real estate market has been on fire. We know this. In every region of the country as well. Some areas much hotter than others. Demographically, many people are moving to Florida, Texas. You've seen just crazy real estate markets. Even in the local market, you have seen, just incredible demand. To have a buyer looking for a house now, they can hardly find a house. There's no inventory, and when they go to buy it, they have to put in an offer that's above ask, and they may not even get it, and they have to offer no inspection even. Even the corporate real estate market has been good with rising rents, and people have been able to pass on the cost finally. There's a big thing that's happening right now, and that's higher interest rates. And the affordability index that has been at an all-time high. You could buy anything you wanted because money was free and rates were low. And if you could have afforded a $200,000 house 5 years ago, you could afford a $400,000 house today. And mortgage rates just hit above 5%. And, many people refinanced in the last few years at under 3%, right? When you start looking at the payments that you're going to have to make in a 5% mortgage world versus a 2.75% mortgage world, many people aren't going to be able to afford the higher price that people, are demanding. So I think we still have a lack of supply right now. People are actually scared to move. They're like, yeah, I could get a great price for my house, but where am I going to go? Because there's nothing for sale. I think that's all going to change over the next 6 to 12 months. Higher interest rates are going to cause that to start to happen. People are going to put their house for sale, and they're not going to have as many buyers for that house because the people that could afford that house can't necessarily afford it now because interest rates are higher. So I think we're at the end of that pricing cycle in most areas. I think some areas are maybe going to flatten out, not necessarily go down because the demand is still so great. So we need the real estate market to kind of cool down a little bit. People do want to move, and there's nothing to move into right now. So it's necessary and will likely happen over the next 12 months.
I can't afford my property taxes anymore.
You should ask Bob for a raise.
We have one more question, and then we can close out, John. And this one's probably for Dan. Dan, could you provide your thoughts on personal savings or lack thereof, and specifically on its impact with inflation and the potential recession?
Yes, personal saving is running around 6.2 or 3%, I think is what it is right now. you have to remember how savings are measured in the national income and product accounts. It's not the definition of savings that you would normally sort of identify with. What they do with savings is they take their measure of income, disposable income, they take the amount that you spent on consumption, they subtract consumption from income, and that's the saving. That's the savings. And the savings rate is that number, that difference, divided by disposable income. That's the saving rate. There's no capital gains or losses in the national income and product accounts. There's no capital gains or losses in the savings measure of the national income and product accounts, national income and product accounts. So if you're thinking in terms of what's happened to the stock market over the last 2 years because all these people were at home buying stocks, right? The stock market went up, there was a huge gain involved. That's not included in the saving number. It's not. It's not part of the number in the current. So the savings is probably higher. The wherewithal or the balance sheet that people have is higher. One of the things you could look at is what is the equity in household balance sheets? What are the value of their assets versus the value of their liabilities? And that's gone straight up. Balance sheets are still in pretty good shape for households.
All right, well, questions are over. Thank you, everybody, for joining us here live and online. And we're here at Stonebridge to answer any further questions. Email, call. We're here to answer them. Thanks for everybody's time.